Welcome back, traders and investors. We have a very special guest on the line, JC Parets, founder of Eagle Bay Capital, money manager, chartered market technician, and also tell us about your new product on Marketfy.
Well, first of all, thanks for having me on again. We're really excited to partner up, with Marketfy and really try to deliver a product for, investors that have been emailing us for years and asking us for, paid service. A lot of times we can't manage money for certain investors, whether they're not accredited or, certain types of tax deferred accounts and things of that nature. So we unfortunately have to turn some assets down. In addition, some people really just like managing their own money and doing their own thing, and I think this service really provides that. So our goal is to deliver, a product with, the same technical analysis and research that we apply to our money management platform on a daily basis. And I think so far we're doing that, and we just want to continue to improve it. Remember, it's always a work in progress. We take a lot of the constructive criticism from our members and things of that nature, and we want to continue to improve this. It's always going to be a work in progress. So we have already established that we have a U.S. Indexes and interest rates package, which includes the S&P 500, Dow, NASDAQ, Russell, mid-caps, etc., Treasury bonds, volatility index. Then we have another product that we've already launched, which is all 30 Dow components on multiple time frames with momentum readings, with relative strength, smoothing mechanisms, pattern recognition. And we have a third package that we've already rolled out, which is the commodities and currencies, which includes 17 commodities, including the energy stuff like natural gas and oil, the metals, gold, silver, platinum, palladium, a lot of the softs, cocoa, corn, 17 in total, including some currency crosses. There's 9 of those in total, including the U.S. dollar index, yen, euro, Aussie dollar, Canadian dollar, etc. So we're really excited, and this week we're rolling out our U.S. Sectors and subsectors package, which includes, financials, utilities, and then the subsectors as well. In this case, it would be, banks, broker-dealers, things like that. So we're really excited.
Now, are you following all those different things? Do you have different technical analysis methods that you use for different products? I know I'm kind of stuck in my way of looking at the markets, very, very basic. I open high, low, close, double tops, double bottoms, like to throw some pivot points in there. Do you use the same? I mean, you're covering a lot of things there. Do you have different techniques for different instruments?
Yes and no. I mean, for the most part, the traditional pattern recognition, support and resistance, our polarity principles, momentum, all of that stuff, we can use across asset classes, and we treat all of that the exact same way. I would say probably the biggest differences are, things like the average true range, for example. It's all about knowing what it is that you're trying to analyze or what it is that you're trying to trade. In some cases, like certain commodities and currencies, they're going to have a different average true range than a Microsoft, for example. So, it's not necessarily a different tool, a different technical analysis, but more so being aware of what it is that you're looking at and the differences in something like that. And then also, when it comes to, our global macro package, which we're actually rolling out next week, when we look at U.S. sectors, for example, or U.S. stocks, I like to look at the relative strength of, let's say, financials relative to the S&P 500, or, if we're looking at the Dow package, ExxonMobil or Chevron or Microsoft or IBM relative to the S&P 500. But when we're looking at our global macro stuff that we're launching next week, if we're looking at Brazil, for example, I want to know how Brazil is doing on a relative basis to the rest of Latin America. I want to know how Brazil is doing on a relative basis compared to the rest of the emerging markets, for example. So in some of the global averages, if we're looking at Germany, I want to compare it to the rest of Europe. If we're looking at something in Asia Pacific, I want to compare it to those guys. So, comparing different countries to their specific regions, or, in the example I just used with Brazil, emerging markets as a group. So we'd compare it to the other BRICS, like India and China and Russia, for example. So I like to compare those particular groups in a very similar fashion to when we're looking at an energy stock, we want to compare it to the energy sector. Or if we're looking at a gold miner, I want to compare it to the miners. So I would say that's how, if there's any difference, I guess it would vary in that respect.
Okay, JC, I got to hand it to you a little bit. We interview a lot of different people on this show, and Boy, we have a lot of bulls like Dennis, and they've certainly been right here over the last 4 or 5 years. I mean, there's been different pullbacks in the market, but you've been a little bit of a tepid bull, and you're looking at things different. Different indicators. What are you seeing now? We hit that 2,000 level. We're pulling back a little bit. Quad wedge coming back. Is there anything that's changed your long-term outlook?
Well, my long-term outlook, remains very constructive. I mean, if you look at a 15-year chart of the S&P 500, 20-year chart of the S&P 500, I mean, we're looking at a monster secular breakout. So big picture, I think the market looks fantastic. Now, obviously, we're talking about what we're seeing today. What I think is going to happen 3 years from now is completely irrelevant. It's just you and me talking, right? It's nothing actionable. So although I'm very constructive big picture, I do continue to see divergences in the market. I mean, we've really gone nowhere this summer. We're the same price in the S&P 500 that we were 10 weeks ago, for example. Meanwhile, the Russell 2000 is down. The mid caps are down. The micro caps are down. So it's really the large caps, for the most part, that are masking some of the damage that's being done, underneath the surface. So, I continue to think that there are opportunities to be long as well as opportunities to be short. On both sides, I think that looking at multiple asset classes also helps. One of the things that we pride ourselves in is really a non-correlated strategy. A lot of pairs trades, for example, where we're long one name, short another, really maintaining more of an equities neutral position, for example. We're looking at, metals, and we're looking at some of the grains. I mean, if you look at, we do a lot of sentiment analysis, for example. And right now our sentiment readings in the S&P 500 aren't really giving us much. We're not really at any extremes. We're kind of just there. And that's really the problem with sentiment. It gets a lot of attention. AAII up a little bit from last week, or AAII down a little bit. There's really a lot of noise, and sentiment is something that we should ignore for the most part. When I start paying attention is when they're at extremes. And right now in equities, we're not really in any extreme. We're seeing extreme pessimism in the grains. So I think that's an area where, we want to look to potentially be allocating capital, really to take advantage of a potential unwind. We're also seeing, precious metals, for example. Look at silver, look at gold. We've been bouncing off these levels for a good year now, but when you look at sentiment, there was a lot more pessimism in the precious metal space over the last year in each of those lows, for example, that we're not seeing right now. There's a lot more optimism in the precious metal space, and I think that could be the catalyst really to take metals down below the new 52-week lows.
Okay,
I think that happens fairly quickly.
Okay, so it seems like if they're selling the momos, they're buying the cyclicals, or there's always money moving around. So
sure.
So they were selling the momos yesterday, and it looks like they were selling every momo stock and just buying every financial stock. What about the relative strength in the financials? What's your take here?
Yeah, I mean, financials have really been a serial underperformer, over the last year or so. On a relative basis, financials peaked last June, believe it or not, which is very worrisome. This is a sector that you want to see outperforming, not, a sector underperforming. But yeah, to your point, we're not really breaking down. We still haven't broken down. We're still holding on to those key levels on a relative basis. And I think that's important. I think if the financials can hang in there, I think it's going to be difficult for the market to have a vicious sell-off. I think financials really need to break on a relative basis for the market to really get hit. I'm looking at the S&P 500, something I definitely want to mention. I'm looking at the S&P 500, this 1985 level or so, which was resistance throughout July. We broke out at the end of August and held that through, the first couple of weeks in September. Now we're breaking back below that. There's some bearish momentum divergences as well. I'd hate to see those failed breakouts. And, we're seeing a lot of it. I mean, we saw it in Tesla. Look at Tesla. You mentioned that, we broke out, above the February highs and couldn't hold it. That was a hard sell-off. And like you said, this is a big Momo name. A lot of people paying attention. So the S&P 500, I think, is setting up in a very similar fashion. So it's not really somewhere where we want to be allocating capital into the S&P 500 right now.
Okay, and let's talk a little bit about the oil sector. I believe the first time that we had you on, they were just kind of starting to rally up, and you said a lot of times, the oil sector, the energy sector, is your last one to peak in a bull market. And boy, you got the nice run up, and ExxonMobil, Chevron Corporation, they made the new all-time highs. And now, of course, the price of oil has put pressure on them. Now they're really coming back down. What's that telling you?
Well, I've run these numbers a million times, and I don't really see any reliable correlation between energy stocks and oil.
Mm-hmm.
I know the media likes to talk about it and compare the two, but I treat them completely different. I don't think one has anything to do with the other. I mean, look at a chart of crude oil and look at a chart of energy stocks. Like, they don't look anything alike. So I think that we should one of the things that I think that I've definitely improved on throughout my career is really focusing on what's in front of me and not overthinking things. The media loves to overthink it. Oh, energy stocks are down. It has something to do with oil. It has nothing to do with oil. Run the numbers. There's no correlation there. So, I think that paying attention to what's in front of you, I think, is the most important thing. So if you're going to be looking at oil, look at oil. If you're going to be looking at energy stocks, look at energy stocks. One has nothing to do with the other.
Okay, just going back to the financials real quick, and let's see if there's any implications, maybe of some higher interest rates. Would higher interest rates be better for the banks, and maybe the market's thinking that you're going to get some inflation numbers and interest rates going up, and, the banks might be able to squeeze a little bit more money out or not?
I've heard that myth before, that higher interest rates are good for the banks. Again, I've run the numbers a million times. There's no correlation there. I've heard the same thing about higher interest rates and the U.S. dollar correlated. Nope, nothing there. So again, it goes back to focus on what's in front of you. If you think interest rates are going up, sell bonds. Like, why are you worrying about what financials are doing? If you think interest rates are going down, buy bonds. Like, one has nothing to do with the other. So, as far as interest rates go, I've been a bear with rates and a super bull with bonds all year. I think it was the easiest trade coming into 2014. Huge sentiment unwind. I think more of a neutral sort of position here in both bonds and interest rates, I think, is probably best. We could probably grind up to maybe 2.7 or something like that on the 10-year. I see plenty of support right now at 2.4. So to be buying bonds aggressively or shorting bonds aggressively, I don't see an advantage in either direction, truthfully. And then, just getting back to what your original question was, I don't think it has anything to do with financials. If you're looking at rates, buy or sell bonds based on that. Financials should have nothing to do with that.
Okay, Rob Hood in the chat wants to know if you see any hidden gems like the Indian play that you pointed out earlier in the year.
That was such a home run, man. I mean, I love that trade so much for so many reasons.
What's the ETF on that?
That trade's got JC written all over, from the failed breakdown, late last year, to the relative strength compared to the BRICS, which you and I were just talking about. I mean, that was when you got Brazil and Russia and China breaking down to new lows, and simultaneously India breaking out. I mean, if that wasn't the tell, I don't know what is. What I like? I think precious metals get clobbered. I mean, I do. I think silver breaks these key lows. That, to me, is one of the most attractive things right now, selling precious metals. I mean, this thing looks bad. I mean, look at a chart of silver. We bounced off this support level last summer in June, again in December, a couple of times this spring. Now we're back down again for the fourth time. And, really my rule of thumb is the more times that a level is tested, the higher the likelihood that it's going to break. It's like, if you punch me in the face, fine, I could take it once. Maybe you punch me again, I could take it again. But if you keep punching me, I'm going to fall down. I mean, it's just the way it is. And the markets are the exact same way. I think one of the best opportunities here, wait for this breakdown. I think it's coming. Sell metals. I think silver's got a big sell-off ahead of it.
And I noticed, too, when gold had a couple of those forced rallies over 1,300, silver just went absolutely nowhere at all. They didn't rally at all. So that's, looking at it on a relative strength basis. I want to go to one of your other calls, and I remember you talking about BlackBerry. You're really bullish. And then, like, the next time you're on the show, I can't remember what it was, the bottom fell out. And I didn't say anything. I'm going to wait. We're going to see how this one plays out. Well, now BlackBerry's come all the way back to the $11 level. Were you able, there's been a couple shakeouts in this. Were you able to maintain your position? If so, what are you doing now in BlackBerry?
Yeah, well, I mean, I still like it. I think it's super constructive, and, getting back to correlation, really has nothing to do with the S&P 500. It really a trade on its own. The home run, it was really the entry point at the end of last year when it broke down below the 2012 lows and we got back above it. That was the initial entry, and then it doubled from there. Since then, we've really been consolidating. I mean, I really like it. I think I still think that we can get back to last year's highs, the highs from January, which we're looking at, potentially $17. I think that, both the weekly chart looks constructive, momentum looks constructive on both time frames. We're bumping up against this key resistance around $11. I think, again, just like silver, the more times the level is tested, the higher the likelihood it breaks. In the case of silver, it's to the downside. Case of BlackBerry, looks like it's heading higher. I think we get back to last year's highs.
Okay, let's cover quick momos here. Just a few comments because I want to get a few of these in. Apple.
What worries me about Apple is that, we're running up against the September 2012 highs. And when markets get up to, previous key levels like that, there's some sort of acknowledgement of that overhead supply. So to be putting money to work in Apple at the all-time highs, to me, the risk-reward, that just doesn't work for me. For me, and if I miss it and it doubles from here, fine, who cares? For me, it's not about, getting every move or getting every trade. For me, it's about looking for the most, for risk-reward opportunities that are skewed in my favor, whether that's on the long side, the short side, Apple, silver, crude oil, Exxon. For me, it doesn't matter. It's just a name. A lot of people look at companies like Apple and they get very, very emotional about it. It's like if you say something bad about their stock, it's like, oh my God, like I'm the devil all of a sudden. But at the end of the day, it's four letters. It's just math. I couldn't care less whether we're in Apple or silver or corn. I don't care at all. So when I say something negative, it's really because I found a risk reward that's skewed in my favor, not because I want Apple to go to zero. I own an iPhone and an iPad and an Apple TV. I love the product, but a company and a stock have nothing to do with one another. So to put money to work up here, I don't like it. You can even short it up here with a stop at the highs. If you really want to be aggressive, I think there's better opportunities elsewhere for sure.
Okay, and this is our last issue we're going to cover. Dennis and I have been having a debate here. A lot of excitement about the Alibaba IPO. Yahoo makes a major run to $44 yesterday. What's your take on Yahoo and how it's going to react to this IPO?
How Yahoo's going to react to the IPO, I have no idea. Nobody does. If someone tells you they do, they're just guessing. I like the fact that Yahoo broke out to new highs, above 52-week highs for that matter. I love that. As far as the Alibaba IPO, I have no idea. There's no chart. I mean, for me to tell you what I think, I'm the last person whose opinion you want or something like that, right? I mean, let's be serious. Yahoo, as long as it holds above, the January highs, I think you can own it. That's, we're looking at about, 41 and change. As long as we're above 41 and change, the stock is fine. On a relative basis, it looks great. Momentum looks great, but that's your stop. I personally wouldn't want to own it if it breaks back below last year's highs and puts in a failed breakout. I'm not saying that's going to happen. It doesn't look like it's going to happen. But that's your level. For me, it's all about levels and risk rewards. If you own Yahoo, that's your level, 41. If we're below that, I wouldn't want to be in it.
Okay, we really appreciate your honesty, your outlook on the markets, JC. Check out his product on Marketfy.com, and we are going to get you back on again soon. Okay, JC?
Well, I appreciate it. Thanks for having me, guys, and you guys go crush it today.
Okay. All right. JC here at Eagle Bay Capital.